So today, the largest retailer on Earth essentially announced that the everyday consumer is, just running out of gas.
Yeah.
But then on that exact same day, a single tech company threw down a $105 billion guarantee just to build out new data centers.
It's crazy.
It is. Welcome to the deep dive, where today is post-market research for Thursday, August 20th, 2026. Really reveals an economy that is just completely split in two.
It's a remarkable divergence, honestly. We are looking at a tape today that, well, it defies a lot of traditional market gravity while simultaneously crushing certain sectors with this just very heavy reality check.
And that reality check was brutal. Let's start by grouping the data because just, rattling off decimal points doesn't do the carnage justice here.
No, it really doesn't.
Across the board today, from the small caps in the Russell 2000 to the blue chips in the Dow, we saw a massive 1 to 1.5% haircut.
Yeah, total washout.
Right, so the S&P 500 is down 0.86% to 7641.16. The Nasdaq dropped a full percent down to 2,760.67.17.
Mm-hmm.
And the Dow shed over 700 points to 52759.21. Even the Russell 2000 slumped 1.3% to 2,992.43.
Yeah.
But the most alarming part isn't just the sheer drop, right? It's the fact that this highly coordinated sell-off completely erased yesterday's relief rally.
And that erasure is, well, that's the key to understanding the current psychology of Wall Street right now.
Okay.
So yesterday, the market experienced what we call yield compression. Essentially, bond yields dipped because the Treasury announced a buyback program.
Right, I saw that.
Yeah, so they were stepping in to purchase older bonds, which, it injects liquidity and gives borrowing costs a temporary breather. And equities loved it.
Obviously.
Right. But today, the structural reality of the bond market came roaring back, and the 10-year Treasury yield surged right back up to 4.697%.
Wow. Which effectively undoes the entire Treasury intervention.
Yeah.
When you hear about sovereign debt or the bond market acting as a drag, it's really easy for your eyes to just glaze over.
Sure.
But here is why this matters to your portfolio right now. Our sources highlight that this week, U.S. sovereign debt officially crossed the $40 trillion mark.
Yeah, $40 trillion.
I was trying to contextualize this rapid shift from yesterday's relief to today's panic, and the Treasury's buyback maneuver, it feels like taking a highly potent painkiller for a broken leg.
That's a perfect way to look at it. The market certainly, ran around on that leg for a few hours yesterday, just completely ignoring the fracture.
Right, but the structural reality, that $40 trillion broken bone, is still there.
It's still there.
Once that liquidity painkiller wore off this afternoon, the market couldn't ignore the underlying math anymore. The sheer volume of debt that the government has to issue just to fund itself is crowding out everything else.
Exactly. It creates this massive vacuum for capital. When the government has to finance $40 trillion in debt, it has to offer attractive yields to find buyers, right?
So that establishes a very high baseline for borrowing costs across the entire globe. And we saw exactly how that broken leg is actively hobbling the real economy today with Deere & Company's earnings.
Well, look at Deere. We all know they are a deeply cyclical company tied to agriculture and construction.
Yeah.
But their earnings report this morning was essentially a masterclass in how a 4.7% 10-year yield acts as just a total chokehold on heavy capital expenditure.
You really have to look at the mechanism of how heavy machinery is bought, though. A commercial farm operator doesn't just, buy a $500,000 combine harvester with cash.
Right, they finance it.
Exactly, they finance it.
Yeah.
So when the risk-free rate, which is the baseline yield you can get from the government, is sitting near 4.7%, the interest rate on that commercial equipment loan is going to be sitting at, 7, 8, or even 9%.
Oh.
Suddenly, the return on investment for upgrading that tractor just doesn't clear the hurdle rate.
The operator looks at the math and says, well, we will just repair the old tractor and wait. Right, and those delayed decisions, they ripple upward. Deere's specific operational results were totally overshadowed today because the macro environment is just suffocating your sales pipeline.
Yeah.
The $40 trillion shadow in the bond market directly translates into vanishing orders on the factory floor.
So if that pressure's coming from the basement, from fixed income and the cost of capital, the pressure from above is arguably just as fierce.
Oh, absolutely.
Let's pivot to the commodity side because the sector heat map today was completely inverted from what you'd expect in a slowing economy. Every single major sector was down today, Except for energy.
Right.
Energy gained nearly 0.5%.
Yeah, the physical market is pricing in immediate scarcity. I mean, WTI crude settled near $86.75, but the real standout was Brent crude spiking to $92.82.
And our research notes explicitly point to the geopolitical flashpoints driving this.
Yeah.
We have an ongoing severe impasse in the Persian Gulf and just mounting instability in the Strait of Hormuz.
Yeah.
But the immediate catalyst today seemed to be President Trump's statements warning of an economic war against Iran.
Right.
Purely from a market mechanics standpoint, how does a trading desk price in a statement like that?
Well, so trading desks are entirely agnostic to the political rhetoric itself. They are purely modeling supply chain probabilities.
Okay, so it's just math to them.
Exactly. When a major political figure threatens economic conflict involving one of the world's most critical oil choke points, algorithmic trading systems and commodity speculators instantly buy futures contracts.
Right.
They are pricing in the risk premium of a supply disruption before it even happens.
Which brings us to the actual economic mechanism of $92 oil. It's not just a number on a screen, right?
Yeah.
It functions as a direct, unlegislated tax on the global consumer.
An incredibly regressive tax at that. I mean, it infiltrates every single layer of the supply chain.
Yeah.
It is the bunker fuel for the container ship crossing the Pacific. It's the diesel in the truck delivering goods to Ohio. It's the petroleum base in the plastic packaging itself.
Right.
When Brent crude holds above $90, it establishes a hard, unyielding floor under inflation. The Federal Reserve can hike interest rates all they want, but a central bank cannot print barrels of oil.
Right. And if every physical good costs more to move because of that oil spike, it eventually hits the checkout aisle.
Exactly.
Which brings us perfectly to the starkest contrast in our research stack today. I asked earlier how the consumer is actually absorbing this unlegislated tax, and today, Walmart gave us the answer.
They sure did.
And the market punished them for it.
Yeah, a drop of over 6% for the largest retailer on Earth.
I mean, to put that in perspective, a 6% drop for Walmart is tens of billions of dollars in market cap wiped out in a single session.
It's massive.
They reported their slowest sales growth in 6 years and issued really weak forward guidance. And this isn't a niche brand. This is the ultimate retail bellwether, explicitly stating that the middle-class consumer is pulling back.
Yeah.
But you'd think this defensive, cash-strapped posture would be uniform across the retail sector. Then you look at the after-hours data.
Right. Ross stores.
It is night and day. I mean, in the late shift after the bell, Ross stores, ticker RS, reported a massive beat and raise.
Yeah.
Their comparable store sales jumped 10%, and their EPS, their earnings per share, hit $2.66. That utterly shattered Wall Street estimates. Their stock is just surging.
It is.
How are we seeing the biggest retailer in the world shrink while an off-price chain explodes?
Well, we are witnessing the raw mechanics of the trade-down effect. When the unlegislated tax of high energy prices eats into a household budget, and credit card interest rates are hovering at record highs, consumer psychology shifts from convenience to preservation.
Okay, preservation.
Right. They don't stop buying clothes or household goods, but where they buy them changes drastically.
Did I migrate?
Precisely. Walmart is losing momentum because their core demographic is feeling the maximum pinch of that macro drag. But Ross Stores operates on a totally different model.
Right.
They are an off-price retailer. They buy excess inventory, often from the very retailers that are struggling to move products, and they sell it at a deep discount.
Yeah, it's that whole treasure hunt vibe.
Exactly. They offer a treasure hunt experience. And right now, middle class and even upper middle class consumers are trading down into that deep discount tier just to maintain their standard of living without, blowing up their credit cards.
It's a fascinating behavioral shift. I mean, the consumer isn't dead. They are just aggressively hunting for margins in their own personal household budgets.
Right.
But this raises a massive contradiction for me. If the consumer is strapped, trading down to survive, and if the 4.7% yield is choking off industrial spending like we saw with Deere, shouldn't the highest growth, most expensive parts of the market be the ones absolutely dying right now?
Under normal financial gravity, yes.
Right.
And we did see the technology sector as a whole retreat 1.0% today.
But then you look at the anomaly, the massive, glaring exception that makes you question if we are operating in two separate economies. Nvidia, on this exact same day of macroeconomic anxiety, just secured a $105 billion guarantee to backstop OpenAI's data center expansion.
Yeah.
I read that number in the brief and had to double-check the zero.
On $105 billion
It's insane.
committed to a single localized infrastructure initiative?
We really need to unpack why that is so structurally bizarre right now. I want to ground this in the concept of the risk-free rate we touched on earlier.
Okay.
If I can get a guaranteed 4.7% return from the U.S. government just by holding a 10-year bond, any tech company asking for my capital has to promise me massive world-changing returns to justify the risk.
Okay. Exactly.
Future cash flows are inherently worth less when the baseline interest rate is high. So how does a $105 billion AI bet get underwritten in a high-rate environment where, like we said, Deere can't even sell a tractor?
Because the AI ecosystem has currently decoupled from traditional discount models. Investors and institutions funding these AI buildouts are not looking at quarterly cash flow generation the way they look at Deere or Walmart.
Right.
They are viewing AI infrastructure as a winner-take-all arms race.
Oh.
So the fear of missing out on the foundational layer of the next technological epoch is completely overriding the math of a 4.7% risk-free rate.
So it's used the ultimate blank check from the future.
Pretty much.
But the broader market reaction today shows a real psychological fracture, doesn't it? I mean, the rest of the tech sector fell. It feels like the market hit a wall today, looking at that $105 billion and collectively asking, well, okay, but when does this actually start generating cash?
And that is the friction point. The broader market is bound by the gravity of interest rates and consumer health. When a staggering sum like $105 billion is committed to AI, portfolio managers elsewhere in the market start sweating.
Oh, for sure.
They realize that capital is being sucked into this massive vortex of future promises, leaving traditional sectors starved for investment. And we can see exactly how they are responding by tracking the overnight tactical rotations.
Right, because institutional money doesn't just sit in cash when they get nervous. It migrates, just like the retail consumer migrates to Ross.
Exactly.
And the capital flow data in our brief shows a massive flight to safety. Money is actively rotating out of the AI at any price trade and into defensive dividend plays.
Yeah.
The primary beneficiary highlighted here is SCHD, the Schwab U.S. Dividend Equity ETF.
It is the ultimate defensive crouch right now. And if you look at the mechanics of why an ETF like SCHD is outperforming the S&P 500 year-to-date, I mean, it makes perfect sense in this environment.
Because it's stuffed with mature cash-flowing companies that pay you right now.
Exactly. When the macroeconomic environment is murky, when you have $92 oil acting as a tax and yields making capital-expensive investors demand to be paid while they wait for clarity, they don't want to rely on capital appreciation derived from a $105 billion bet on future technology. They want the tangible quarterly cash return that a dividend fund provides.
And the risk radar for tomorrow's session explains perfectly why they want that safety net right now. I mean, we have 3 massive items dropping on Friday that could easily set the tone for the rest of the quarter. Let's start with the loudest one, the Jackson Hole jitters.
Oh yeah, the Federal Reserve's annual economic symposium in Wyoming. It is historically a prime venue for Fed shares to signal major policy shifts, which means it is a massive catalyst for volatility.
And the whispers leading up to tomorrow are leaning heavily hawkish. The brief notes that Fed speakers Daly and Musalem have been highly focused on persistent 3.4% inflation.
Right.
We know the Federal's target is 2%. If they take the podium tomorrow and signal that 3.4% is just too sticky to allow for aggressive rate cuts, how violently does the bond market react?
Well, if the Fed signals they are paralyzed by sticky inflation, the yield on that 10-year bond will likely spike even further. The market has been desperately pricing in a soft landing with a smooth glide path of rate cuts. If that glide path is removed, the pressure we saw in the basement today will intensify, putting even more downward pressure on tech valuations in capital-heavy industries.
Which connects directly to the second risk on the radar, which is geopolitical escalation.
Yeah.
We just talked about the Persian Gulf impasse putting a floor under oil.
Yeah.
If a headline drops overnight about an actual disruption to the shipping lanes, that 3.4% inflation the Fed is stressing over, so it looks like it could go to 4% or 5%.
It's a vicious feedback loop. I mean, geopolitical tension spikes the cost of energy.
Right.
The energy spike keeps inflation sticky. Sticky inflation forces the Fed to keep interest rates high, and high interest rates crush corporate earnings and consumer spending.
It's all connected. Which brings us to the final piece of the puzzle dropping tomorrow morning, and that's the August PMI indicators of the Purchasing Managers Index.
Right. This data release will be the immediate catalyst for the opening bell. It is the real-time scorecard for the broader economy.
But the specific fear outlined in our research isn't just about general slowing. They're explicitly watching for a surprise jump in services costs.
Yeah.
I want to highlight the danger there. If the PMI shows that services are getting more expensive, while at the exact same time Walmart is telling us physical goods are slowing down, that is the textbook definition of stagflation, isn't it?
It absolutely is. It is the worst-case scenario for a central bank. High inflation in the service sector coupled with stagnant economic growth.
Right.
If the PMI data confirms that narrative tomorrow morning, the defensive rotation into dividend funds like SCHD won't just be a tactical trade, it will become a stampede.
When you look at the entire landscape we just mapped out, stubborn 3.4% inflation, $92 Brent crude acting as a tax, a $40 trillion sovereign debt shadow, and an anxious consumer hunting for bargains, it becomes incredibly clear why the market couldn't hold on to yesterday's optimism.
Yeah, the structural reality simply overpowered the temporary liquidity fix.
And that is exactly the value of stepping back and doing these deep dives. I mean, when AI hype is dominating the financial headlines, it is really easy to lose sight of the mechanics driving the real economy.
So true.
You have to stay data grounded. Understanding why a 4.7% yield stops a tractor purchase or why the consumer is migrating to off-price retail is the only way to actually navigate the noise.
Before we close out this session, I think there is one final angle from today's data that we haven't explored yet, but it's crucial for our listeners to consider as they review their allocations for tomorrow.
Oh, let's hear it.
We've spent this entire dive examining how high rates and a $40 trillion debt burden are actively crushing capital expenditure and consumer health.
Right.
But here's the adjacent thought to chew on. If this $105 billion AI infrastructure bet actually delivers on the massive, unprecedented productivity boom that it promises, could that technology trigger a deflationary wave powerful enough to solve our sovereign debt problem organically?
Wait, really? Just inflate or deflate our way out of it?
Yeah, exactly. Will AI simply automate away the inflation that the Federal Reserve is currently fighting? Consider that as you look at your tech and defensive allocations tomorrow morning.
That's a wild thought.
Is the market splitting in two because one side is dying or because one side is about to rewrite the rules of macroeconomic gravity entirely?